I'm Ric Edelman. If you sold your second home, what would you do with that cash? And where's the best place to invest these days? And Jean will be here to explain how to tune in to your inner voice. All that and much more on this edition of The Truth About Money.
This program is funded in part by TD Ameritrade. At TD Ameritrade, we support investors and independent registered investment advisors every day, providing access to tools, research, and educational resources that help you pursue your goals with confidence.
I'm Ed Burns. I've spent a lot of time around cameras. However, I've never actually swallowed one before. Till now. It's a camera the size of a pill that lets your doctor see inside of you. That's kind of awesome.
Technology is evolving. We believe the way to invest should evolve as well. A prospectus is available at 1-800-iShares, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Investing involves risk, including possible loss of principal.
I'm Ric Edelman. People often tell me that when they find themselves with extra cash, they spend it. Well, you know me, it all comes down to dollars and cents.
Hi, Rick. I'm Kathy, and this is my husband, Steve. I retired a year ago, my husband 6 months ago. Some things came up, and we spent some of his 401. I have a little bit. I have two homes, the home I intend to move to for retirement purposes, and the one I'm going to fix up and sell now. The problem is, when I sell this house, the temptation will be very great to make all kinds of upgrades and finish the basement of my new house, buy some new cars, etc., etc. I'm realizing as a retiree, money's kind of hard to hold on to. Is there a certain percentage of like any windfall money that I ought to put away and consider sacred? I would appreciate your advice. Thanks.
It's not so much a percentage because it will vary dramatically person to person based on their circumstances. What it really comes down to is figuring out what are the goals, what are the current circumstances, and how can we make sure our current circumstances are such that we're able to achieve those goals. But I have a bigger problem here that you may not have realized. I heard an awful lot of usage of he versus me in your conversation, and I'm suspicious that there isn't a lot of us going on. He withdrew money from his retirement account. You have houses and you're planning to sell a house and you're going to do this and that. If you're going to have a successful retirement together, we need to start talking about your joint goals, your mutual circumstances, and how the resources of both of you can be applied to the achievement of those joint goals. If you continue to operate the way it seems that you apparently are, I'm afraid that we're going to be facing a future of disappointment and strife. Remember, a successful wedding, a successful marriage, a successful relationship is the union of two separate people into one. From a reality television show chef to one of America's most trusted film critics, we asked them just one question, Celebrity Edition. What is the worst financial advice you ever got?
The worst advice that anyone ever gave me about money was that it wasn't important in life. I mean, I think that in everything that I do, that, commerce without a margin is a hobby. And I think that everything we do, even the things that we pursue for passion and art, need to have margin or profit associated with them. It's fundamental. It makes them better. Inherently better for what they are as art, but also profitable.
What's the best investment? I recently answered a question like that for troops at Fort Belvoir.
I have done the rainy day plan, have that situated. I have no debt, and I'm in the process of buying a small cottage for myself so that I have a place to put my bags when I'm not deployed and on missions. And I help my family out a lot, my mother and my two brothers. My brother has a small business, a pizza shop bakery, and I do help with that, and I enjoy it. And I don't have children, husband, and so I am also investing more. I have investment properties that I'm interested in, nothing large scale. I'm also, my big question for you though is gold and silver and overseas investments. I'm very interested in that. I have already dabbled with the gold and silver, and I don't know really which is the best versus gold versus silver, and how much is really kind of for the value for myself. And as far as overseas investments, guidance anywhere on that.
We are very nervous about precious metals. And this is not merely because of the fact that gold hit its all-time high in the summer of 2011. And as of right now, it's down substantially and well into bear market territory, with a lot of folks expressing fears that it may fall even further. Gold has been in a bubble for some time, and that has always been a worry for us. However, gold, no question, is one of the major asset classes. And we believe investing in all of the asset classes on a global basis. So having 5% of assets in precious metals, or I would even say more broadly, natural resources, to include not just gold and silver and platinum and palladium, but also oil and gas and other commodities such as timber. And commodities futures as well. We would argue that commodities make sense for maybe 5% of the portfolio. Not because we think prices are low, they're going to get better, but because it makes sense to own them in a diversified portfolio. What we don't like is when people get greedy or people get speculative and believe that, hey, gold is on its way to $3,000 an ounce. There's no economic basis for that argument, and we find that those people are mistaking investing for gambling. And the two have nothing to do with each other. So 5% of your assets in natural resources overall. And whether you're choosing gold versus silver, I don't think you should. I think you should do both. That's the whole point of a diversified portfolio. As for international securities, which is defined as anything outside the United States, something that is not dollar denominated. We definitely agree that foreign investing makes an awful lot of sense. We routinely have our clients investing overseas, but you have to recognize that there are two very big problems when investing overseas. The first is foreign currency risk. Not only do you have that foreign asset rising and falling in value, but the value of that currency to the dollar is rising and falling, and it's a double-edged sword. You can lose both ways. The asset not only might fall, but the currency might move against you, and what looks like a 10% loss just became a 20% loss. So it's very risky to invest overseas. For that reason, we limit our clients to no more than 20% of their portfolio. For a great many of our clients, it's as little as 10 or 15%. For a lot of our clients, it's none, simply because the risk is too great for their situation. So if you wanted to do 15 to 20%, that would be the maximum we would recommend, because you're not only dealing with foreign currency fluctuation, you're also dealing with sovereignty risk. There are nations that have been known to nationalize companies, and due to what happens with the fortunes of war, literally, it's just a very risky thing. So limit your foreign currency exposure, we believe, to 15 to 20% of assets.
Roger, and also in regard to, would you include then property? I may be going on an investment property situation with some of the guys I work with. And
real estate, you mean?
Roger, yes.
We also agree that real estate belongs in a diversified portfolio, but real estate has two problems. First, it takes an awful lot of cash to buy real estate. You can open a mutual fund account or an exchange-traded fund with $100. You can't buy a real piece of real estate with $100. It takes thousands and thousands of dollars. And as a result, people tend to buy only one piece of real estate because that's all they can scrape enough money to go do. And now you're not diversified. You've got all of your investment in a single piece of real estate. I would much rather, I'm sure you would too, own hundreds of pieces of real estate. So what we do for our clients is to have them buy REITs, a real estate investment trust. A REIT kind of looks and acts like a mutual fund, where you put your money into the fund and it buys real estate for you. But now, instead of a single property, it diversifies. It buys dozens, even hundreds of properties. It'll buy residential, commercial, retail, manufacturing, agricultural, raw land, office buildings, and it'll do so in a wide geographic area. So you're diversified in number of property, type of property, location of property, all of which is designed to reduce your risks. So it's more affordable because it doesn't take a lot of capital. It's more liquid because you're buying shares of the REIT, so you can move your money in and out as you need. So that's how we prefer to expose our clients to the real estate sector. But some clients just do prefer to own individual pieces of real estate, and that's fine, but recognize that that's more of a business than an investment. Because you're gonna select the property, you're gonna manage the property, you're gonna deal with the tenant and the maintenance and repairs, the property taxes, the tax implications associated with it, amortization, depreciation. It's really more of a business than an investment, but it works as long as you recognize those issues.
Thank you so much, sir.
You're very welcome, thank you.
Do people with low credit scores pay more for auto insurance? Yes or no? We'll be back with the answer right after this.
In the not-too-distant future, there will be a revolution in the way we power everything from smartphones to cars. And scientist Ramez Naam explains that the energy revolution will mean big investment opportunities, not just in the US, but across the globe.
We're in a world with 7 billion people on our way to 9 billion. Only about 1 billion have access to air conditioners, automobiles, and so on. And so the world as a whole needs to increase our energy production by about half over the next few decades. At the same time, we have the problem of climate change, which means that we can't do most of that through fossil fuels, and certainly not through coal. So there's a lot of people looking now at the future as being solar and wind, and the bridge to that, the interim fuel, really being natural gas that's replacing coal and is poised to replace a little bit of oil.
Is this going to solve the problem then, going to solar and going to alternative energy sources? Is problem solved? We just have to get there?
We can solve the problem, but it's going to take a while. The sun hits the planet with 5,000 times as much energy as we use from coal, natural gas, and oil combined. So there's plenty of energy there, but it's expensive to harness. So it's going to take decades. It's going to take 20, 30, 40 years to make that transition away from oil and coal and even natural gas to solar and wind.
Do we have enough oil and gas and coal to last the 30 or 40 or 50 years before solar takes over?
We'll see. It's really hard to predict the future. Oil is not looking as good. What's looking really good right now is natural gas. We've had a huge boom of natural gas in the US, and many of the techniques that have unlocked natural gas in the US are things we might be able to export to other countries to unlock their natural gas deposits as well.
What's it going to take to make solar the energy source most commonly used?
It's really more R&D, more innovation. The cost of solar has gone down by a factor of 20 since 1980 because we've made solar panels thinner, used less materials, made their cost lower. So we're going to have to do that again. We're going to have to cut the cost by about another factor of 2, and that'll take another 5, 10 years.
Are you confident that it will happen that fast?
You can't ever be certain of what's going to happen in the future in energy. The past is littered with bad predictions that didn't come true, but we have a chance.
Now, let's fast forward to the future. Solar is in place, miraculously, just like that. What do we notice? What's different in our daily lives when we convert to solar energy compared to oil and gas?
Well, I think we'll have a little bit more of our energy being collected at the point that it's used. You'll see solar on rooftops, especially in the southwest and the south of the US. And I think in the long term, we'll see prices come down.
Well, you raised a really interesting point. Solar makes a lot of sense in the southwest US where it's bright and hot pretty much throughout the entire year. But what happens as you move north? What happens in Canada? What happens in Northern Europe?
Yep, it's definitely cheaper in some places than other. And right now it is in the Southwest and Southern California and Texas where it's cheapest in the US, but that moves up. And even places like Seattle, where I'm from, we don't have a lot of sunlight in Seattle, but just over the mountains to the east of us, it's high desert, and we do have a lot of sunlight. So it's possible to move this energy via transmission lines, so that's the short term. In the long term, we have to build energy storage, and that means advanced batteries that can store some of the day's sunlight as electricity for use at night.
Almost like a cistern collecting the water when it rains.
A lot like that, just the same.
If solar is heavily dependent on direct and frequent sunlight, Africa strikes me as a wonderful place for solar development.
That's absolutely right. So about 1 billion people today don't have electricity at all. And for them, it's a poor life, if you will. But they're poised to benefit a lot from the creation of solar panels because those can be spread very easily and cheaply where there is no grid, and because Africa and India and parts of Central America get so much sunlight, solar power may actually be cheaper there than it is in the United States or Europe, helping to lift those people out of poverty without making any impact on the climate.
Meaning that if companies are looking for workers and they're looking to build factories that they can operate inexpensively from an energy perspective, build the factory in Africa.
In many cases, that might be right, and that might be a very good thing for lifting people out of poverty while making things cheaply and cleanly.
How can investors take advantage of these new technologies that are being developed in a broad array of energy?
There are funds now being founded that invest specifically in wind power, in solar power, and advanced batteries. I would look at all of those. I'd be careful about investing in any one solar company or any one wind company because it's such a competitive marketplace that most of them will go out of business.
So invest in the industry rather than the company itself.
Absolutely.
And funds enable you to do that through diversification.
Absolutely.
And I would assume you have to regard this as high-risk capital.
It is high-risk capital.
Looking for a long-term payout.
That's right. If you have the patience to be in the market for the long term and you're willing to invest broadly, then I think alternative energy can be a great investment for the 10-year, 20-year time frame.
Ramez, thank you so much.
Thank you.
Do people with low credit scores pay more for auto insurance? The answer is yes.
Financial advisors like me work to help you build a better financial future. And each week, Anderson Wozni and Brandon Corso join me on the radio to help people find solutions to their money matters. Kevin's up from Memphis, Tennessee. Hey, Kevin, how are you?
Hey, I got a mortgage or a refinance question. I've had my home now. I bought the home new in 2004, I believe it was, and I bought it at 246. That's what I financed at 5.63%. It just this year, like most people, my home has fallen in value, so it's now been appraised for property tax purposes at 205. I owe 213 on it still. So my question is does the advantage of refinancing at a lower mortgage rate outweigh having to face all those upfront mortgage interest?
How long, Kevin, do you plan to stay in the house?
Probably at least another 5 years or so.
Is it pretty confident that you're going to get out of the house in 5 years, or might it be longer?
It really is. I don't have any confidence one way or another.
Okay, that makes it difficult. That makes it difficult to figure out, because if you were confident you'd stay in the house 10 years or more, absolutely we would tell you to go ahead and refinance, even if you had to bring cash to the table, which is quite possible something you'd have to do. But with only 5 years to go...
Yeah, so often people are going to look at the rate they have and then the rate they would get at their refinance, but they ignore the fact that it's going to cost $2,000, $3,000 to refinance, and okay, how long am I going to be in that house? And so that, as often as anything, drives really the decision.
See, here's what it comes down to. Let's say that refinancing saves you $200 a month, but it costs you $2,400 to do the refinance. That means it's going to take you 12 months to break even. You see the point? So you just want to compare what does it cost to do it versus how much does it save me and how many months is it going to take for me to get to break even on an after-tax basis. And with only 5 years before you might sell, I'm not
Questionable.
sure.
But
It's questionable, and he needs to actually check because he said it appraised at, according to the county records, 205. That's not what they're going to appraise it. They're going to appraise it based on what it would sell for.
Which is completely irrelevant of the county appraisal.
But it's worth the time to look into it, Kevin, because your rate would probably fall by about 2 full percentage points. And on a $200,000 loan, we're talking about saving hundreds and hundreds of dollars every single month.
So it is worth pursuing, no question, Kevin. You are definitely in the camp of maybe. So I wish it could be more definitive. The more confident you are that you're going to stay in the house longer, then the clearer it becomes that this is something you should absolutely positively do. So since you're solidly in the camp of maybe, pursue the numbers because the numbers will make the decision. It's really that simple.
And how funny is it that we're talking about somebody maybe needing to refinance because he's got a 5.5% rate?
Yeah.
Life's good. In terms of people who are in debt, life's good because interest rates have never been this low. We'll never see them this low again. So if you haven't refinanced, do it quick while you still can. Most of us have heard the joke, I'm so broke I can't pay attention. Well, here are some real funny money moments from Dangerfield's Comedy Club in New York.
You ever go to Whole Foods? You go in there, you're like, nobody touch anything. You know how you know there's a lot of money in Whole Foods? The carts work. You ever grab a cart? Pooh, you're like, what the? I go to Stop and Shop, they're all stuck together. They're not even the carts from the store, they're like Target and Bed Bath & Beyond. My girlfriend's like, I'm gonna get a basket. We gotta get this done. I'll meet you inside. I'll get a basket. We'll put it in a cart. You get the one with the locked wheel. You're like,
If you could ask a financial advisor just one question, what would it be? Here's one we hear from a lot of people. What is the biggest mistake people make involving children and money?
I think the biggest mistake I see that parents make with children and money is the fact that they don't educate them early enough and teach them about money early on. Because the problem that we're seeing is kids get into their their late teens, or in 21 and beyond, and they don't have an understanding of how money works. So teaching them about money, how it works, how to be financially responsible, these are very important lessons that they can carry with them.
I think one of the biggest mistakes that clients and people make with regards to their children is that they focus too much on paying for college as opposed to taking care of themselves and paying for retirement.
You can have very spoiled children, you can have children who have no sense of money, or you can have children who don't have the discipline to save for something down the road or delay their gratification for down the road.
If you're trying to make a big decision, listen to your inner voice. That's what Jean, my wife and business partner, wants to talk about in her segment, The Other Side of Money.
I wrote this story because it was a great life lesson for Rick and I. We were out of town and we were going out to dinner, and we just hopped in a cab to go to the restaurant. And on the way to the restaurant, we got in a little car accident. But afterwards, Rick and I were talking once we got to the restaurant, and what he was telling me was that before we were going out, he had this tightness in his stomach, and he just felt like something was going to happen. I was like, oh my gosh, why didn't you listen to that? That's your body trying to get your attention that something that we're about to do, something needs to change. Our body is constantly on a subconscious level picking up what's going on around us. We need to stop, take a breath, and we need to think about what we're about to do, what's around us, what's happening. And so these little signals, we need to listen to them. It's our instinct. We all have it. We're born with it. And whether we choose to really tune into it, that's something that we really need to try to focus on. There's a great relaxation in that inner knowing that our intuition and our instinct is going to lead the way.
Thanks, Jean, for reminding us that this TV show is more personal than finance. And that's our show for today. I'm Ric Edelman for The Truth About Money. See you next time. To learn more about the topics we discussed on this episode and a chance to ask your questions, visit our website at truthaboutmoneytv.com and stay connected by liking us on Facebook and following us on Twitter.